The following is a presentation of TFNN. The Trader's Edge with Steve Rhodes. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. The Trader's Edge. Now, Steve Rhodes.
Good afternoon from TFNN. Welcome to the November 4th wonderful Wednesday edition of today's Trader's Edge show. I'm your host, Stevie Perseverance Rhodes, who absolutely knows that each of us should always be pioneers of our future versus prisoners of our past. Hope everyone out there is having a great day. Let's make sure we have an extraordinary one. Of course, the easiest way to do that is to always remember that life happens for us, not to us. That's right. When you take that one little 2x4 out there, you make that one little shift. What it means is that we can find the gift in every set of circumstance that life is going to throw at us. Today, we get to go look at the circumstances of what the market is communicating to you and I, what the bulls and the bears, the buyers and the sellers, what they're doing, at least as of 1:07 p.m. And what I want you to know is I'm absolutely grateful for your presence here. Now, I'm here to serve you, so feel free to pick up that phone, dial on in at any time at 877-927-6648. Internationally, our number is 727-445-1044. You can send me an email, steve@tfnn.com. I'll try to get to that, as well as inside the Tiger's Den. You can instant message me anytime that you want. So let's get this wonderful Wednesday kicked off. Of course, this is Tiger Financials Network. I'm Steve Rhodes. Welcome to the show. Right now, we got the Dow trading off 82 points. There must be something wrong with my screen. But the S&P is off 11 points. She's trading at 2,098. NASDAQ off 16 at 51.29. Russell 2000 off about 5 points. She's trading at 11.86. Gold's off $7 right now. Silver's down 17 pennies. Light sweet crude off $1.67. Leading the charge here to the upside is Tesla Motors. That's up $21, a little over 10%. Amazon up $18. Google's up $10. Baidu's up 6. You got to the downside, Regeneron Pharmaceuticals, that's off $25. I think that was the upside yesterday. USANA Health Sciences off 12.5%, down 16. Fargo Technologies off about $11. Papa John's Pizza. They are apparently they're not giving pizzas away for free today, but they are down $8.60 out there. So let's go ahead and try to figure out just what in the heck the markets are communicating to you and I. Now, yesterday we took a look at some longer-term charts, so we don't really need to spend any time there. But let's go take a look at one thing that we really didn't do yesterday was take a look at where from a trend standpoint, where are we in our price oscillators? And we take a look at the New York Stock Exchange, NASDAQ Composite, and the Dow. Now, all three of those are still above the zero line. The one that is closest to the zero line looks like it's the New York Stock Exchange. Let me just switch over here real quickly. I'm going to have to switch to two different spots. So sorry to turn my head to you, but my laptop is where I've got my other numbers written down. Okay, so let's just take a look at where we're at with regard to net declining issues today, just so we can understand the market breadth or lack thereof. So right now, as of 1:10, we have advancing issues of 1,000, declining issues of about 2,000. So we've got about a 2-to-1 ratio. Net difference right now is minus 981. In order for that price oscillator to get below zero, we're going to need twice this level of the down thrust. We need 1,712 issues, really, just to get just below zero. So, we're a little bit more than halfway there, or the market is. Otherwise, it's just taking a breather is really what it's communicating to you and I. If I come back and I take a look at, and the NASDAQ itself, it's nowhere, and I say it's really nowhere near that level, meaning the zero line. The NASDAQ would need about 1,609 issues to be exact. So it's actually holding up pretty well with regard to market breadth. So if we were to get below zero in all three of these indices, the New York Stock Exchange Composite and the Dow, with what was primarily a descending tops price oscillator, that pattern kind of got blown through yesterday. with the exception of the Dow out here. Now, I can't tell you exactly how many issues inside the Dow is needed. We're still above zero. As long as they stay above zero, even with the Dow trading up 90 points, and the market's just not ready yet to form a top, or at least that's what the message is as of about 1:11. The other thing that you and I want to really keep an eye on is the volatility index. Now, you won't hear this anyplace else. I don't think you'll hear it anyplace else, but by goodness, you will hear it here. And what the VIX needs to do today, you're at 1583. Until it gets above 1635, I think 1635 is the number. Is that the number? Give me a moment here. Oh, that's not the number. Where the heck did that chart go? Ah, here we go. Let me give you the number. I don't want to give you the wrong number out here. I want to give you the right number to call, and I want to give you the right number to be paying attention to assist you in your trading. 1586 is the number, and right now we are trading at 1580. 6 cents will make all the difference in the world. Now, the reality is, if it closes at 1586, don't let your skirt fly up. You'd really like to see a stronger close than that. Of course, what the VIX is doing, it's teetering on the spot. If we take a look at what we have right now today, we've got a one-day rate of change of 8.5%. with a trade at 1576. I don't know if 10 more cents, that's going to put us up to 10% or not. The problem is that if we have a greater than 10% one-day rate of change, we have a real good chance of at least a bounce. That's what you would see in the morning. So I don't know how this is all going to pan out here today. But ideally, if the market has made a top, if it's going to make a top, you're going to see really three things. Doesn't mean you'll see them today, but you're going to see three things. If you did see all three things simultaneous today, then that would be an indication that you could come in on the short side. Otherwise, you still could be a day or two early. So the numbers to be watching, it's really that simple. We don't have to do anything else for the next 45 minutes. We can actually play tunes. We can play show tunes if you want. I don't care. But what we need to do, what the market would need to do, as far as the market giving you a signal, you got to see the VIX close above 1586, and then watch to see what type of rate of change that was over the past, over between yesterday's close and today's close. And then you need to see New York Stock Exchange price also to get below zero. Composite do the same, as well as the Dow out here. Otherwise, and we'll go take a look at the pullback in the market. So we'll go over and take a look at the ETFs. I should have had this done, but it just hopped into the driver's seat here. So we'll just simply do it live. No problem. Give me a moment to just get my tabs all set out here. What we want to do is take a look at the volume inside of the ETFs, just try to get a feel for where we're at. So we've been trading for nearly 4 hours, 3 hours and 45 minutes. So we'll put 3.75 in my little calculator here. And let's switch over now and take a look at volume. So the volume inside of the Qs right now is 18.9 million shares. So that's pretty decent volume for this time of the day. It would help if I could actually type. So you got about 18.9. Inside the IWM, 16.5, we'll call it. Inside the SPY, 55.7 million. And inside the Diamonds, 3.7. We've actually got pretty good volume then today with the market having moved lower. Let's take a look at the Qs out here. Qs suggest that we would see a day of about 33 million shares, give or take. So let's go see where the Qs are trading. Now, the Qs still have not got back inside the range. Inside the range would have to mean a close below the July 20th high. So the number there to write down in your pad of paper is going to be 114.39. 114.39. Okay, 114.89 was the 1.618. So 114.39. Ideally, what you would really see is just to let me do this here. So I'll give you a couple different levels. So a close back below 114. What did I say? 114.39. That would be a level. It's going to, this chart here is probably, if it's difficult for me to read, I can only imagine what it's like on your end. So we're going to clean this up just a tad. We'll turn off the Fibonacci expansion, which was 1.618 expansion. We'll turn off the TAS profiles too right now. What the market actually did, if we take a look at our swing points of September 17th, that high down to low on September 29th, what we'll see is that what the Qs were able to do yesterday and the day before was get up to the 1.618 expansion level, 114.89. So we're going to go ahead and turn that off. And what that means is that if price if the market doesn't really pull back here, what that says, the Qs are going to target the 119 level. So we know what the upside target is at this stage of the game. If we take a look at, so we'll turn off those Fibonacci numbers. We don't need that at this moment. Now, in order for there to be a failure today, let's see, did we get above yesterday's high? I think that we did. The high today, 115.47 versus 115.42. So the problem is that in order for there to be a failure of either yesterday's high or, more importantly, the swing point from the trading session of July 20th, you have to do lighter than 26 million shares. We've done 19 million shares already. So we're not going to get the volume failure pattern inside the Qs. In fact, we're definitely not going to get that. That being said, we know that you can't fail on price. You can't fail on volume at this stage of the game, unless everybody just really does go home. You could fail on price by getting back inside the lower part of the range. I would say just closing back underneath the high of July 20th is not good enough. You really want to go ahead and just simply reject the entire candle. That means you need to see a close below 113.48. Now, so you've got that number to put down on your pad of paper. If we take a look at our market profiles out here, we can see that we are above. Well, maybe you can, maybe you can't. Let's turn off our horizontal lines. Let's actually come back over to our profiles. Let's turn off our daily for the moment. So now we're just looking at weekly profiles. This says that you've got to close back below the price point of 114.39. So that's another level to be watching. If we don't do that today, then the market was actually pushing higher with volume, right? So we know we've got volume. The question is this pushing higher or lower? Well, at this stage, we've taken out yesterday's high. The only conclusion that we can draw is we are actually pushing higher. Now, we can go take a look at intraday charts, and we can try to split hairs here. But what you and I are looking at is support levels and what the market is doing. And that's why we're taking a look at these numbers. Now, that's the weekly TAS high. If we take a look at the daily out here, so let's punch that up on our screen. Let's take a look at the high. That's at 114.08. So you've got to see a close below. Really, you just go with the low of the candle session from July 20th. That'll get it all done, except from the volume standpoint. So in order for the Qs to truly fail here, what Stevie says is you've got to close below 113.48. Now, you don't have to do it today. That could happen tomorrow. But if it doesn't happen today, then you're kind of left in limbo out there. So that's the message of the Qs, in my opinion. Now let's go take a look at the IWM, the Russell 2000. What do we know about the Russell 2000? Well, we know a couple of things out here. Let's take a look at the Russell 2000, and we'll go back to Danny's question inside of the den out here. As we take a look at the Russell 2000 yesterday failed on price. I believe it also failed on volume. Let's take a look at it. The volume that we're looking at, the day that we are benchmarking, is September 17th. That was a key swing point. The high there was 118.89. Yesterday, you got slightly above that. Today, you got slightly above that. The volume you're benchmarking was 50.4 million shares. Yesterday, 28 million. Today, you're going to do another 28 million. So the IWM, you've got two failures on price and volume at its swing point. So we've got a failure out there. But here's the deal. The Russell 2000 ain't going to take the market lower. It needs the Qs to do that. Steve Rhodes with TFNN. We'll be right back. Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
TigerTV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. TigerTV, exclusively at TFNN.com. Steve takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. Dow's up 82, S&P down 12. We're going to go to Nashua and speak with Lou. Lou, thanks for calling. Thanks for holding. How are you doing this afternoon?
Very good, Steve. Thank you.
Excellent. You wanted to take a look at the S&Ps. Tell me what you're doing, how I can assist you.
Well, I'm not doing anything yet. Just wondering if it's a good time to short the S&P via SPXS.
Here's what I would do, because we're so close to either a resistance level, which means you could then perhaps sell it from a higher area, or we're going to see the beginning of a breakdown, and that is just really watch the VIX index. If at the close today, going into the close, you see the VIX index trading above 1586, then I would say, yeah, it's safe to go ahead and fire away at that trade, and I would put the stop somewhere below, this morning's low. If we take a look at the SPXS right now, SPXS, the low, I don't know if it was today or yesterday, the low from yesterday, oh, shoot, I didn't mean to do that. That's the son of, okay, I'll have to go change that. But that's weird. So the low of yesterday looks like that was 1768. So you're in this trade net. No, that can't be.
I think it was 15.
Low was 1580. Sorry about that. So you'd have to have your stop somewhere below 1580. But what I would do is I would wait to see if the VIX index can close above that level of 1586. That's really going to be a key spot, because then that gives you the chance. Then we ought to see the VIX index at least move to 1807, and during that process, you should see the S&P 500 move back. So, I know the market has sold off a little bit today. We've seen some indications on some shorter-term charts, such as a 30-minute for the futures contract. We haven't seen a TAS market profile form lower than the previous box for a while. So that looks like okay. That's suggesting to us that we could see some lows. So, that we may have seen a top out here. If I look at the 120-minute time frame, we've got to close below 2,097.50. Now that's another important area for you to watch out here. So the 2-hour chart says, yeah, we might be there. The 5-hour chart says not so fast. The 5-hour chart says, hey, you've got to close below 2,085 in order to really have it give us a signal. So, simultaneously, and we're at 2,092, that's only 7 more points. I would say, Lou, that if you see the ES Mini close below 2,085, you're going to see the VIX index above that level, and then your signal is going to be to go ahead and take that trade. Now, the caveat will be, depending on how bad of a close we could see today, you could also see that VIX index really make a move to the north. That would give you typically a rate of change greater than 10%. And what will typically occur over the course of the next 24 hours, sometimes it's 48, but the next 24 hours is you see some type of bounce in the marketplace. Now, the way that Asia traded last night, you could actually see that occurring. I don't think that Asia is going to sell off just because of the way that our market is behaving here. So you might also get an opportunity, maybe you take half the trade going into the close, and maybe you take a look at if the market does bounce, you've scaled into a position out there. So that's how I would look at it as of 1:28 in the afternoon right now. Does that help you, or what questions does?
Yes, it does help. Great deal.
Okay. So I really believe the key today is going to be the VIX index. We covered it during the first segment. You'd really like to see these price oscillators get below zero as well to give you a confirming signal. But you asked specifically about the S&P, and that's what I would be watching for the S&P for SPXS. All right, my friend? Right.
What do you think about getting into the miners?
I think that here's what I would say. The miners have held up, some of the miners, not all of the miners. Some of the miners have held up really well while we've had this decline in gold. I think that gold is getting close to forming at least a short-term bottom, if not a bottom. I don't know which it is just yet. But gold probably, Lou, is going to try to get down to the 1099 to the 1086 level before it actually finds a bottom. And during this decline off of the October 15th level, some of those miners have held up really well. So the answer to that question would be, if you get into the right strong miners, then it might be worth the trade. But I would suggest this. If you're taking a look at the shorting the S&P 500, the question I would pose to you, what are you anticipating as some type of correction? Is this a short-term top, immediate-term top? Because if this is something longer than just a short-term top, I think the miners might also break loose to the downside. Hey, we'll be right back. If you want to hold on, you can. This is Steve Rhodes with TFNN. We'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on TigerTV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. Lou wasn't able to hold on, but I still wanted to go ahead and answer the question, really for you and Lou. How about that? And the question was this: should he take a look at getting long the miners? And the reason I wanted to bring that up was because on one side, what Lou was looking for was to go short the S&P 500. So I didn't get his take on the trading plan with regard to, is this a short-term, long-term type trade out here? And really the whole point was to take a look at the S&P 500. So if you watch this on Tiger TV, that's the top panel of my screen. The center panel is the GDX. So we're going to just simply take a look at the miners as a basket. Now, what I did mention to Lou was if you're going to go into the miners, make sure you go take a look at the strong miners out there. Do not go after the GDX because the basket is, the weighted entities inside the GDX are not all so strong out there. The bottom portion of my chart is gold. So we know gold's moving lower. That's clear. We talked about gold continuing to move a little bit further south. We gave you those levels. There's at least a short-term oversold bounce that is due. Now, I don't know if it's a bounce or it's a bottom out here. I just don't know. But it's still headed south. If your take is that the market is about to make another significant top here for a while, what I want to do, and the reason to put this chart up on the screen out here, is can we really anticipate that if the market's going to move south with regard to the S&P 500, even though the S&P 500 is not weighted with miners specifically, but just let's take a look at the general market and let's take a look at Lou's specific question out here. How likely is it for the miners to hold up through any kind of significant decline inside the market? And really the chart, history just simply tells us. If you just simply look at coming back here to about September of 2014, Okay, we're in November 2015. The center part of the screen, you can see that the as the S&P cut loose, so did the miners out here. So did gold. You know, gold was moving lower. Even if we take a look at gold moving in the center portion of my screen, the GDX and the gold contract, you know, those two almost look like I have the same directional, from a directional standpoint, like I have the same symbol up. I don't. Those two do the two-step tango all the time. You know, if you trade one, in essence, you're basically trading the other. Now, the decline inside the miners, no doubt, has been so much better than gold itself out here. But what is the likelihood, as we take a look at this chart out here, that the miners are going to at least move north during a decline out here? I can see it moving sideways, so some more sideways movement out here. But wouldn't the better time to time the mining trade be when that next bottom might come in inside the S&P 500? So, you know, if you go back and you do this correlation, you take a look at it, you'll see that, you know, if you're anticipating the S&P 500 to move south, guess what? The miners are not going to be the only ones out there that are going to be saying, bucking the trend. At least that's what historical patterns inside these charts suggest to both you and I. So, you know, whether history can repeat itself or not, I believe the answer to that is yes. Had a request to go, so hopefully that assists you in your trading, or at least your thinking out there, whoever that might be, anybody that's listening. Let's take a look at, had a request to go take a look at Disney. Just looking for my tab here to do that. There we go. So let's go take a look at Disney. We've got a trader that's in a short position, I believe, via some puts out here. I've already lost some of where was that? Okay, can we take a look at Disney? Bought a few puts this morning, November 27th expiration, 114. Oh, already sold half of the profit, so good deal there. So it looks like, let's take a look at Disney. It's trading at, hey, this thing is traded off quite a bit today, so nice move out there. Big old key reversal session and everything, really right at about resistance. So where's Disney headed to? Let's go take a look at, let's sit on our market profile, see if we get any kind of picture out here. So prices come down to the a level of support, potential level of support, meaning we're at our weekly high just below it and our daily high. So if Disney is going to move further to the south, what I would say is you're likely to find some pretty decent support around the 109 area. So if you're still in those, right around 109 is where you might want to take a look at taking the other portion of that trade off, or adjusting your stop in that trade, because if you do see a move down below 108.65 to be exact, then what you're likely looking at is around 102.83. And you're talking about November 27th. So today's only the 4th. So you've got, you know, nearly 3 weeks for that trade. So what you want to do, volume today is pretty good. 15 million shares to the downside. That trade looks pretty good. So I'd watch 108.65, and if you can get below that and volume is accelerating, you're looking at 102.83, maybe even 96.42. I don't know if we'll see that kind of rapid drop, but anything is possible out there. So a great trade. Glad to hear that. That was on Disney that you and I were taking a look at. Now, there was another question. It wasn't really a question. Somebody had posed something inside the Tiger's Den. Janet Yellen, I don't know if she's still on the stump or not out there, but we've got a lot of Fed speak going on and talking about interest rates and so forth. And the, you know, you've all heard of the double mandate out there, right? And what I am, to me personally, just like you and I, we took the time to go take a look at the S&P 500. We took a look at the miners out there. We took a look at gold, just to understand correlations. You know, what I like to do is to really let the charts talk, you know, because all the rest of it, you know, what we don't know is whether somebody's just listening to somebody else. Nobody does their homework. They just regurgitate somebody else's BS, all stuff before Steve said, hey, let's just simply go spend a little bit. How much time did it really take for you and I to put up one chart and put up a correlation between, you know, the miners and the S&P 500? I mean, that had to take a whole 30 seconds. And then we can go back and we can take a look at those correlations just to better understand things out here. Now, what I wanted to do is with regard to the so-called, everybody is focused on interest rates rising. Now, some of you have seen this chart before, and we've looked at it a number of different ways out here. What this chart shows us is the Dow, That's the blue line on my screen out here. And the brown line that's on my screen is the Fed funds rate. And the whole thing is that we know that we're down around the zero level, right? And so the whole thing is, if we go back and take a look at other points in time, we haven't had this extended period of time of low rates like this. We can see some other bases that were formed back in 2003, 2004, back in 1992, 3, 4 time frame out here. So we can see that, where we saw those bases plateau. And then as rates began to rise, if you just take a look, as rates began to rise and you start taking a look at the Dow, is there really anything, I mean, other than a couple-day event or something like that, is there really anything that should give the press all this coverage and all this BS stuff out there about, the market is going to tank? I mean, it is amazing the amount of mind time. Just take a look at back here during the 04 time period when rates began to rise. We saw the market also rise with it out there. Is there any reason to believe that this won't be the same out here? Well, let me show you the reason why it could be. Because that's really the so-called dual mandate. And they're not really clear. We can be very clear about it when you and I take a look at charts. But it won't be, what you and I know is that if the market craters and it starts to move to the south, what it will not be the cause of is higher interest rates out there. It just simply won't. This goes back to 1987. You cannot prove to me, because it doesn't exist out there, that higher rates mean that this market is going to go lower. So that should really be the end of the story, and nobody should be even talking about this. What we should be talking about, the other correlation that truly is out there, the so-called dual mandate. Forget about the inflation issue out here, okay, or full employment. The reality is, they talk about full employment, don't they? That also is BS, okay? And the reason that it's so BS is because if we get to full employment out here, what that typically is going to mean, well, it may not, but what it could typically mean is that there are fewer job openings, right? You see, how the market performs better is when there are plenty of job openings out there. When all of a sudden the job openings start to dwindle, just take a look. Now, this chart only goes back to 2005. I apologize. The Bureau of Labor Statistics, the other BS outfit out there, only has data going back to 2005. I would gladly take that data. If somebody could show me where to find that, I would gladly take that data going back further, and we would take a look at it. But the real issue that people could talk about all day long so that we focus on the right thing out here, if you really don't want the market to crater, then what you want to see is more jobs out there. You want to see job openings. You can get this stuff right off the Bureau of Statistics. You just have to take the time and then go ahead and chart it out here. But the reality is, okay, if this starts to crater out here, and they don't talk about it, right? They're talking about full employment. I mean, that is really talking out of one side of their mouth, when the reality is they do not want full employment out here. I guarantee you. What they want is they want to continue to see more jobs that are available. Once we start to see that turn, just as we did back here in 2007, that is going to be a huge problem for the market. So it is not about interest rates. You don't have to spend any time on interest rates other than understand, maybe your positions inside debt out there, or if you are a small business and you're on some type of floating rate, which most small businesses are, right? You are some percentage rate above prime. Then you're going to, take it in the shorts, or like, who was the guy that was on yesterday afternoon? What's that guy's name? Stanley Druckenmiller. What's his? You know who I'm talking about. The one thing I only heard him for about 2 minutes between. I was going to work out, and I heard him on CNBC. And he was making some correlation about he was talking about the debt service obligations that we have for seniors out there, and he did some kind of he took a look at. So I haven't investigated this. I don't know if it's accurate. I don't know where the pitfalls in his calculations were, but he was talking about how, I think it was over the course of the next 20, 30 years, that the reality is that the 19 trillion that we've got pales in comparison to what it will be, just to be able to take on the fund on the liabilities out there, for seniors, for guys like me out here, that's going to grow to be a couple $100 million. That's assuming that interest rates don't increase much, right? So interest rates are likely going to increase. It's not going to be, that's not what the issue is for us to be watching the market out here. So that is not even my take. It is not my personal take. This is just simply data. And yeah, I know that, figures lie and liars can figure BS. This is it. It's really that simple out here. So that is the so-called truly dual mandate that I would say is in the marketplace out there. And that's what we have to look for. Now, the question is, can we trust the Bureau of Labor Statistics out here? They get it right, sort of, eventually out here. And it's a lagging indicator. So I think the date, we've got Jobs Friday coming out this Friday. So we'll get some more information on that. But it's always, I think it's like 2 months behind, a month behind at least, with regard to that. So, okay, enough of that, enough of the soapbox, but hopefully that puts to bed for you in your mind, and it will at least clear your mind with regard to the commentators and other folks that are out there. Why are they spending so much time on something that is so absolutely useless? Okay, let's take a look at. So we looked at gold. We looked at that. We looked at the S&P. If we go take a look at currencies out here, hey, you got a strong dollar today, right? Up 86 pennies. It's trading out at 98 bucks. Let's go see where that is headed to. So this is taking out another swing point from the trading day of October 28th. Looks like a little bit lighter volume, but it doesn't really matter. It's a basket of currency pairs that is controlled by the euro. So it looks like at this stage here, you've got the dollar headed up to 98.70. I believe that there's others that are targeting 101, and Stevie's targeting 102. That is likely to where the dollar is headed. But really, it's not so much that correlation as it is where's the euro headed. Because when you can understand the euro versus the U.S. dollar, then you can understand where the dollar is headed. Now, inside the euro versus the U.S. dollar, the real key swing point out here, in my opinion, is right here. We're about to test it or get down to it. Maybe I didn't tag it exactly out here. Let me turn off those market profiles. We don't want to look at those on this because I don't know that it's accurate. So let's not worry about that as we take a look at that currency. So right here, you can see this is the level of support, 108.19. And we're at 108.49 as we speak right now. You've got a nice wide-ranging bar coming into this level of support. Now, that is not how you want to see price moving into a level of support. You want to see small ranging bars, not wide ranging bars. Last time down here, you saw small ranging bars. That was July 17th. That was July 20th. And you saw a nice big move off of that with a nice wide ranging bar. Now you're coming into it with a wide ranging bar. Now we're not down there yet. I don't know if we're going to get down there today. We may get down there today. And if we do get down there today, or we get down below that level, that's what says that we go back into this swing point area of either April 13th in 2015, because there is no other base out here. There's no other base of support. It's not that price can't stop, but there's no other base of support. So you're either getting back to April 13th or you're getting back to March 16th. And voila, if you go back to the U.S. dollar index and you go take a look at those days, well, guess what? March 16th, that was the 102 level. And so that is likely to be where the U.S. dollar index will go to. Now, we know that there's some directional correlation between the U.S. dollar and gold. So, maybe gold, even though it's going to have a short-term bottom out here, maybe it's just doomed. Steve Rhodes with TFNN. Right.
Are China A shares hot or not? If you trade China A shares, now may be time to take a closer look. Trade CHAU or CHAD, Directions Daily CSI 300 China A Share Bull and Bear ETFs. China A shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let falling markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.
Join David Dwight as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
Welcome back, folks. Dow is off 67. S&P is down 11 points right now. So let's go back to that basic premise here. Let's put it all together, at least how we take a look at the euro, the U.S. dollar, gold, and where that might head to. So what you and I know is that the euro is very likely going to at least test 108.19. Now, if it holds that level, holding that level, even though you're coming down with a wide-ranging bar, then what you would anticipate and expect is that when I said gold should find a short-term bottom, that's what we would anticipate and expect here. So one way to perhaps time that is watching this 108 area. Now, because we are coming down with a wide-ranging bar, that suggests that maybe this time it's going to go ahead and blow right through it. If it does blow right through it, gets below 108.19, then it says those next two levels, we already took a look at that. That would put strength into the U.S. dollar index. You can basically forget about all the other currencies, just really focus on the one that's 65% of the weighting. If that's going to move lower, then that also says U.S. dollar index is going to get stronger. And if we take a look at the correlation between the U.S. dollar and gold, top portion of my chart is gold, bottom portion of the U.S. dollar index, only I've inverted it so that way that we can take a look at the directional correlation. So in this case here, the bottom line on my screen, if you see it moving lower, it's really the U.S. dollar index getting stronger. We can see that correlation actually still exists today pretty well. You can't use this to identify just how far. It's not meant for tick for tack. so to speak. It's a directional thing. So if the euro breaks through that level, U.S. dollar index is going to be moving lower. Gold has been moving lower. There's no reason for gold to stop moving lower out here. So that's why watching that level on the euro is very important. And one of the things that we did yesterday, one of our dinners out here, I believe, had asked to take a look at some of the longer-term charts. And one of the longer-term charts that we looked at with our horizontal trading ranges out here, that's the red horizontal lines going across my screen, as well as we have a descending, long-term descending price channel that's in here. That what this suggested to us is that gold could easily get down to 1041, 917 more likely the next stop if it's going to have some real pressure to the downside out here. So all of this really fits together. There's no uptrend when we take a look. It just depends on the type of time frame. Right, on a daily basis, gold was in an uptrend. Well, guess what? It bucked that trend. It said, the heck with you. I don't like being in an uptrend anymore. And to prove it, all we have to do is go take a look at it. Okay, there's no longer any kind of uptrend here. I don't care whether we use a trend line, whether we use a channel line out here, there ain't no more uptrend inside of gold. So that being said, and we've got a couple wide-ranging bars, 1099 easily it should be the next target, and we'll have a better feel for whether it's 1099, Agent 99.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You're watching Tiger TV.